If you're in the UK, getting your crypto taxes right is crucial, especially with HMRC's specific rules. And for everyone globally, a massive change is coming that will impact how your crypto transactions are reported to tax authorities worldwide. We're talking about automatic exchange reporting that kicks off as early as 2027. In this video, we're going to break down the UK's unique Section 104 share pooling method for crypto. And then we'll dive into the Crypto Asset Reporting Framework, or CARF, explaining what it is and how it will affect you. You'll learn how to navigate these complex rules and stay compliant.
First up, let's talk about the UK's approach to crypto capital gains. Unlike many other countries that might use FIFO or first in, first out, UK taxpayers are required by HMRC to use the share pooling method for calculating their crypto capital gains. This isn't just a suggestion, it's a legal requirement. It means you can't just pick and choose which specific crypto you're selling to minimize your tax bill. Instead, HMRC treats all of your holdings of a single asset as part of a pool. This pooling method is designed to simplify calculations by giving you an average cost for your assets rather than tracking each individual purchase. It's a big difference from what you might be used to with stocks or even crypto in other countries.
So, how exactly does this share pooling work under Section 104? It's all about maintaining a weighted average cost for each crypto asset you own. Let's say you have Bitcoin. Every time you acquire more Bitcoin, its purchase amount and cost are added to a single pool for Bitcoin. When you decide to sell some Bitcoin, your cost basis for that sale isn't the price you paid for a specific coin. Instead, it's calculated by taking the total pooled cost of all your Bitcoin and dividing it by the total quantity of Bitcoin in that pool. This gives you an average cost per coin. Then you multiply that average cost by the amount of Bitcoin you sold. This method applies independently to each crypto asset, so you'll have separate pools for your ETH, your SOL, and any other tokens you hold. This calculation directly matches HMRC's requirements under the Taxation of Chargeable Gains Act 1992, Section 104.
Let's walk through a quick example to make this super clear. Imagine you buy 2 ETH at £1,000 each. Your ETH pool now has 2 ETH with a total cost of £2,000. A little later, you buy 3 more ETH at £1,500 each. Now your ETH pool has a total of 5 ETH, and your total pooled cost is £2,000 plus £4,500, which equals £6,500. Now let's say you decide to sell just 1 ETH to find its cost basis. You take your total pooled cost of £6,500 and divide it by the total quantity in the pool, which is 5 ETH. This gives you an average cost of £1,300 per ETH. So when you sell that 1 ETH, your cost basis for that specific sale is £1,300. This way, HMRC ensures a consistent and fair method for calculating your capital gain.
Understanding this is critical, especially if you're actively trading crypto in the UK. If you're not using the correct Section 104 pooling method, your tax calculations will be wrong, and that could lead to issues with HMRC. It's not just about paying taxes, it's about paying the right amount of tax and demonstrating compliance. Many generic crypto tax tools might default to FIFO, which, as we've discussed, is not what HMRC requires. This is a common pitfall that UK crypto investors need to be aware of. Using the wrong method could result in you overpaying or underpaying your taxes, and neither is ideal.
While UK share pooling is specific to HMRC, it's just one of many cost basis methods out there. Different countries have different requirements. For example, the US, Canada, and Australia often use FIFO or first in, first out. The US also allows LIFO and HIFO as variants of specific ID, where you can choose which specific lots to sell. Germany has its own FIFO with a 12-month tax exemption, and France uses PMPA, which is a weighted average method. Japan uses a total average cost. The key takeaway here is that there's no one-size-fits-all solution for crypto tax reporting globally. You need to know which method applies to your specific jurisdiction to ensure accuracy and compliance.
Now let's shift gears to a major global development, the Crypto Asset Reporting Framework, or CARF. This is a game changer for crypto tax compliance worldwide. Starting in 2027, exchanges in 48 jurisdictions will begin automatically reporting their crypto transactions directly to tax authorities. This means your buys, sells, trades, and even transfers could be shared without you doing anything. By 2029, this framework expands to include a staggering 67 jurisdictions, and yes, that includes the US. Or think of it as the crypto equivalent of FATCA or CRS for traditional finance, but specifically for digital assets. It's designed to increase transparency and ensure that crypto investors are complying with their tax obligations. This is a clear signal that governments are getting serious about crypto taxation.
So, what kind of information will these exchanges be reporting under CARF? dTax has introduced a CARF transaction data export feature that lets you see exactly what will be shared. This export generates a CSV file with 10 specific CARF format columns. 5. These columns include things like the transaction date, type asset, amount, counter asset, fiat value, the exchange used, wallet address, and even the transaction hash. dTax also automatically maps your transaction types to CARF reportable categories. For example, your buys and sells become crypto fiat exchange, trades become crypto exchange, and even staking or mining rewards are mapped as income. This level of detail means tax authorities will have a comprehensive view of your crypto activity, making it crucial to have accurate record.
Given these complex international rules like UK share pooling and the upcoming CARF reporting, managing your crypto taxes manually can be a nightmare. This is where a tool like dTax comes in. dTax now fully supports the UK share pooling method, ensuring UK taxpayers can accurately calculate their capital gains according to HMRC rules. It's one of 13 international cost basis methods supported alongside others like FIFO, LIFO, and Japan total average. For CARF, dTax offers a dedicated transaction data export, letting pro and CPA users preview exactly what exchanges will report, helping you prepare for 2027 and beyond. 6. With support for 22 blockchains and 29 exchange CSV formats, dTax helps you consolidate all your crypto data. Check out getdtax.com. It's open source and free to start, with unlimited import and 5 AI chat queries per day on the free tier.
Let's answer a couple of common questions. First, do I need to do anything about CARF right now? While CARF reporting starts in 2027, it's smart to start tracking your transactions accurately now. This way, when exchanges begin reporting, your records will align. The CARF export feature in dTax is available for Pro and CPA users to preview their 2026 transactions, giving you a head start. Second, what if I'm a UK taxpayer, but I've been using FIFO? You should correct your past tax filings using the Section 104 pooling method required by HMRC. It's better to proactively fix any errors than to wait for an inquiry. Tools like dTax can help you recalculate your historical gains with a correct method.